Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back, kick up your feet, because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Hello, Lower Alabama. Hello, Gulf Coast. Welcome in. Welcome to Coasting in Retirement. Thanks for joining us today. Josh Knoll here. Got a very special guest host today. He's a double major at Auburn, finance and accounting. And he's also the producer of our radio show. Yeah, that's right. Peyton Knoll. Son Knoll is joining us. Son, how you doing?
I'm doing good. Staying warm.
Yeah, staying warm. How?
It's 50 degrees outside. It's way too cold for this.
Well, we are back here in Coastal College's recording studio, beautiful downtown Fairhope, putting together a great show for those of you tuning in. And this will be our last show for 2025, Peyton, right?
Yes, this is the last one I have to edit before the New Year's.
That's right. Yeah, our next one will be coming out the first Sunday of January, but you all will be hearing us. If you're hearing this this coming Sunday, then Merry Christmas coming up, and then also Happy New Year. And thank you for a fantastic year. We are wrapping up 3 years of this show. Is that crazy?
Yeah.
Yeah. If people knew that what our first recording studio quote was, they would crack up how far we've come. Well, listeners, Peyton and I are here today to discuss financial topics relevant to those of you in or near retirement, living your best life along our part of the Gulf Coast. Here's what we've got in store. First segment, deep dive on the topic of the day. Second segment, about 30 minutes past the hour. Stay tuned for headlines of the week. And then roughly 50-ish minutes past the hour, we got our third segment. We call it Josh's Crystal Ball and Big Mouth. We got a lot of predictions to get to. We got a lot to get to. Let's get at it. Quick background on me for those of you new to the show. Again, my name is Josh Knoll. I'm a fee-based financial advisor. I hold my FINRA Series 65 securities license, and I'm the owner of Gulf Coast Financial Advisors. That is a 100% locally owned, 100% independent investment management and financial planning firm. We have offices in Fairhope, Orange Beach, and Mobile. You can find more information on me and the team at Gulf Coast Financial Advisors by visiting our website, gulfcoastfa.com, or feel free to give us a call anytime, 251-327-2124. If you just missed that contact info, get a pen, get some paper. We're going to repeat it several times throughout the show. For today's show, we're going to attempt to answer this question, now that I got young precocious Peyton in the studio. Is my generation, which I'm Generation X, and any other generations old enough to have adult children, are we raising a generation of gamblers versus investors? Are we raising a generation of gamblers? So, Peyton, when we were doing show prep, you corrected me that I called you a millennial. You're not a millennial.
No, I'm Gen Z, and in fact, all your children are Gen Z.
You're all Gen Z.
We're all Gen Z.
How did I miss that?
I don't understand.
So your Aunt Megan, my sister, is
a millennial.
She's a millennial. All right.
Gen Z starts around, I think, 98 or 2000, somewhere around there.
Okay. All right. Well, being 50 years old, I grew up. So our topic, again, is going to be, are we raising a generation? So Gen Z, what would be the generation above you?
Millennials.
Okay. So we're really, is Gen X and baby boomers, have we raised some of the millennials and Gen Z, and maybe even younger than you, whatever the next generation, are we raising a generation of gamblers? I grew up in an era where investing meant reading the newspaper. Have you ever read a newspaper?
I read the fake newspapers at like the 50s diner in Gulf Shores and Orange Beach.
Oh, man. One of my favorite things used to be is reading a newspaper. I haven't done that in years. Anyway, investing was we read the newspaper. We'd go, there was a whole section like in the Wall Street Journal where you could look at all the tickers and the price, and there'd be price in eighths. 1/8. It's crazy. You'd call your broker, this dinosaur thing called a broker. And then later, at best, we got to log into clunky websites on a desktop computer. Everything was slow. Everything about it was deliberate. So contrast that with what we have today. I look at the tools that, my kids and everybody else's kids have, and we think, okay, are we encouraging them with all these tools, with basically having what I would consider a casino in their pocket in the form of a smartphone? Are we not doing a good job of teaching them the difference between buying a business, which is investing, and betting on a ticker symbol, or worse, betting on futures for various things? Is that gambling? So, Payne, before I keep rambling here, what's your first take on this topic? Do you think your peers view investing anything like my generation does?
None whatsoever.
Okay, elaborate.
Well, it's coming from my friends themselves who don't even invest.
Okay.
They gamble. You see how many prize picks, all of the sports stuff, they go, it's fake money. So they gives those codes and they invest, they bet on every single game. And even beyond stuff like that with the blind boxes nowadays, with any type of consumer culture. I know you guys definitely didn't have those types of things.
No.
It is teaching, I think Gen Alpha, which is a generation younger than us, is going to be even worse when it comes to just the gambling mindset. And I think even from just my finance classes, just the immediate reaction to any type of news is a little bit more gambling mindset than having time to sit and think about it.
Right. Well, so I have 2 points to that. And one, I think the statute of limitations probably well run out. But in college, I had some friends that were bookies. And on game day, they would be so busy, right? Now, you don't really need a bookie, right?
No.
So full disclosure, listeners, I can't speak for Peyton, but I don't gamble. I find casinos actually kind of sad, which is funny in my line of work because a lot of times, especially on the broker side, investment management, they tend to be where they don't mind putting some money on the table. I just have never been interested in gambling. And, some people will say, well, investing in the stock market is gambling. We're going to walk you through, listeners, and hopefully younger generations tuning into this show on why that's actually not true, okay? But as far as needing a bookie, like for my second question then is, do your friends and the ones that you know that gamble, what do you think the amount of time they spend thinking about their next bet versus thinking about a particular stock that they could buy that might increase exponentially over time?
They're thinking way harder about the sports bet than they are any type of investment.
My gosh, this is even worse than I thought. So we're raising a generation of gamblers. We've already answered the question. So let's see if we can help. If we can help you listeners tuning in that have some kids, it's time for an intervention, an investing intervention. So let's do a little compare and contrast between what is gambling and what is traditional investing, and see what we come up with. So the one thing that gambling and investing have in common is that on both sides, you're putting money at risk. All investing involves risk, and gambling certainly does. You're putting your money at risk for a potential gain, but the fundamental difference is going to lie in mathematics, ownership, and time. So your grandma, my mom, she's a math teacher. Let's start with math, okay? When you are gambling, Payne, do you know, before we did show prep, have you ever heard of a negative sum game when it comes to gambling?
I've heard of it, but didn't quite understand.
So, for example,
So more likely to lose.
Well, what it means is that there's always, it's a zero-sum game. If I'm gambling, there's somebody on the other side of my bet. Now, that could be you and I, betting $20 on a football game. That could be you gambling at the casino or betting on, or any of us betting on a sports book. If I win, the house loses. If I lose, the house wins. It's a zero-sum game, right? And you can even extrapolate that to a lot of crypto. Crypto is what I call, at least with the meme coins, we're going to talk more about crypto here, you crypto bro tuning in, but crypto is what's called the greater fool theory of investing. Do you know what that means?
We discussed this the last show I was on.
That's right. Yeah, it means that as long as you find a fool that has greater money than you to pay more for something that you spend on, then you're fine. But it's musical chairs. Whenever the music stops, if you can't find a greater fool, then a lot of times your investments plummet in value and sometimes they go to zero. Investing, as opposed to gambling being a negative sum game, investing is a positive sum game. When you buy stocks, hopefully what you're trying to do is you're buying a piece of a profitable company, or you're buying a piece of a company like a lot of tech is this way, where they're focused on growth. I don't know how many years it was before Amazon that launched their stock back in 97 or 98. I think they went many, many, many years without a true profit, but they were investing all that money back into the company, right? And so people that were buying in Amazon stock, as one example, were not necessarily looking for profit, but they were looking for upside growth potential. And what you're looking over the long term is, for example, like the S&P 500. For decades and decades, the S&P 500 has had a positive expected return of around, depending on how you calculate it, 8 to 10%. Now, that doesn't mean that the S&P 500 index is going to produce 8 to 10% year after year after year. In fact, people are surprised at how much variation there is in that actual annual return. I'm just giving you the average. But at the end, what you're hoping is both the investment that you make in the company that you're buying, the piece of the company in the form of stock, and you can win at the same time. Does that make sense?
Yeah.
Okay. All right, now let's talk about, we said we had math and then we had ownership. So Peyton, if you want to buy a piece of Apple, what do?
I download Robinhood
Well, not the technical, but you buy an Apple
stock.
stock, right? And that gives you a piece of ownership. Obviously, a very, very small piece, but you have a piece of ownership. When you buy a share of a company, you literally own a piece of that business. If the stock price were to drop, and the stock price is determined in secondary markets, NASDAQ, New York Stock Exchange, so on and so forth, you still own the same percentage of that business, which means that if you extrapolate it out, you've got at least some vested interest in that company's factories and facilities, patents, its brand, its products, all that stuff. And also, too, when you have a stock, you're hoping that, particularly if you're buying into a stock that has a company that has a pretty consistent profit, that they're going to share some of those profits in the form of a dividend. Gambling, on the other hand, does not involve any type of ownership. You're completing a contract on an event. So you bet on a game or a horse, and you have the contract, but you own nothing. You have a contract that is either worth everything or zero at any specific moment in time. Once the event is over, the contract is complete. Make sense?
Yep.
Okay. Then last thing we mentioned was the time factor. So let's go back to let's pick on your friends. We're not going to name names. We'll get them in trouble with their mom and dad. But when they are doing all of these bets, is it like they place 2 or 3 bets and they just let it ride? Or is it just a continual process of rebetting and what do they call those when you can get in at the last minute kind of stuff?
Well,
what's the process look like?
Well, they love to wait until after halftime to place their bets on a certain game.
Okay.
So there's a little bit of a trend. That's
called in-game betting, right?
Yeah,
Okay.
they love the in-game betting and even overtime betting. You can bet as soon as it gets to overtime or something like that. That is what they like to do, and they do the parlays.
The parlay. That's what I was trying to think
the
of.
16-leg parlay. Well, the thing is, they get free money. Invite your friend and get free $10 to bet with.
Okay.
So that's half of all they use. You should have seen how many times I have my friends come to me. Can you use my code? Can you try this
Oh
app?
my gosh.
And they use the fake money and they bet these 16-leg parlays. And it'll hit every now and then and they'll be rich.
Yeah, they'll be rich, right? And does any of them ever fully disclose to you how much they've lost, or do you only hear about the wins?
Well, I don't hear how much they lost because they swear they just bet using fake money. But they also can't cash out until they've made, I think, $100 in earnings or something.
So that can take a while.
That can take a while. So, and they always get that thing where one of them doesn't hit, and you have the hope that you're going to hit the next time.
Well, is it true? Do you agree with the statement that gambling is a sprint, a nonstop sprint?
Oh yeah.
Okay.
We're at dinner, and they have their phones out on the table, and they're just looking at it. And I'm like, we're not even watching the games.
Man, when we're done with this recording, you're going to send this episode to your friends. We're going to get them.
They're going to get mad at me.
I'm even more alarmed than I thought I would be. Investing compared to gambling as a sprint, investing is a marathon. Time is the investor's greatest ally, because what you're hoping for is compound growth. You're wanting the power of compound interest and growth, that your earnings begin to earn their own earnings, that you have interest paid upon interest, and so on and so forth. The volatility of the market going up and down, it can be very severe in the moment, but if you look at the history, and there's no guarantee that the market's always going to go up and to the right, and all investing involves risk, but if you look at the history of the stock market, it has gone up and to the right for decades upon decades, okay? Now, we mentioned this earlier. We're talking about the casino in the pocket. I was saying that if we ever wanted to bet on a game, we had to find our local bookie. But for you all, you have the casino in your pocket in the game in the form of a smartphone. You mentioned the Robinhood app. So let's talk about the Robinhood app or the Robinhood effect. Do you know much about it?
I don't know much about the effect. The most I know about Robinhood is a lot from the movie Dumb Money.
That's great.
And Sebastian
That's a
Stan
great movie.
is playing the CEO.
Yes.
That's the most I know about Robinhood.
Now, that guy has actually turned into kind of a rock star celebrity.
Yeah.
Yeah.
I've seen that.
He talks at events and has quite a following. And I, again, full disclosure, listeners, for better or worse, I've never used the Robinhood app, but I do know that at one time it would do digital confetti when you made a trade, and that it has the look and feel of a video game. Peyton was never really much in video games too much. Your brother got to a little bit. I was never much in video games. But my understanding is that the Robinhood app, as opposed to using something like the Charles Schwab app, has a very much of a video game look, and it has more of like a social media type of feel to it. Do you think that's that's
Oh,
accurate?
I think that's very much accurate.
And do you think they're looking for the dopamine hit of the trade and or
Well,
of
I
all
think they're
that?
just trying to reframe investing as a more hip and cool thing. And
You think
I-
Robinhood is?
I think, well, the app is very similar to the sports betting apps. If you look at them side by side, they look exactly the same.
I think that's by design,
Yeah.
right?
So I think it's very much just a dopamine hit
It's
when
a
they
do-
have the confetti stuff
Okay.
versus the old school of calling somebody.
This is really important what we're talking about. All right. Now, let's pivot. We talked about Robinhood. Robinhood also has some correlation with crypto, right?
Your favorite topic.
Well, I try to call balls and strikes. And we have an article later in segment 2 where crypto had a big win this week, and we're going to be fair about it. But recent studies have shown that young people, particularly young men, are disproportionately drawn to high-risk assets like crypto and another thing called zero-day to expiration options, which we don't have time to get into too much. But it's kind of like it turns it into a little bit of poker night. These are the things that they say that draw young men to crypto. First, obviously this is related to social media, but showing status. I don't know if any of your friends, these gambling addicts that we were talking about, I don't know if they show any of their stuff around crypto. Are they into crypto? That's a
No,
better
I am
question.
not friends with anybody that's into crypto.
Now, why is that? That's amazing.
I guess I don't surround myself with those types of people.
Just a smart kid.
Well, I definitely have seen some people into crypto in my finance classes, and they're a little off.
They're
I don't
what?
mean to say that for anybody that's investing in crypto, but the people in my finance classes, the crypto is part of their personality.
Okay.
So
Okay, I think this is fair to say. It almost produces a cult-like
yes,
behavior.
Yes.
Is that fair? Because I have friends in it too, and I try to be fair. And again, crypto's had some big wins, and we have a very crypto-friendly administration, so we always try to call balls and strikes. But it's particularly in the early days of crypto, it was almost like they were speaking this different language as they were part of this cult thing. The other thing with crypto is you have, in my opinion, Peyton, I'm jumping up to a meta thing, but I do think that your generation and even the millennials have been a little bit disillusioned with the stock market and its ability to make them wealthy, and they view crypto as a way to get rich quick, get rich now. Do you agree with that?
I do agree with that now.
And
I think it's a young person's game is in crypto.
Right. And they also have I just mentioned it, but they have a distrust of the traditional system. They have a distrust of, some of them are old enough to remember when 2008 crashed. People definitely are, the ones we're talking about were old enough to see the COVID-related crash in 2020.
Well, I think a lot of them got burned by the meme stock, and then after that happened, they fled to crypto.
So they viewed meme stock investing as traditional stock market as fast. That's interesting.
That was their
Which
chance.
it had
and then
nothing to do with any of it.
and then they kind of got screwed.
Man, that is really fascinating. But, some of the stuff that I hear, again, balls and strikes. I think it's fair for the younger generation to have a little bit of mistrust of the traditional stock market system because, Peyton, we talked a bit about this on the show, but the stock market is somewhat artificially inflated through the federal government's monetary policy of constantly having these large federal deficits, which means that they got to print more money, which means that the dollar value is constantly being eroded, and that money tends to find its way to water flowing into the stock market and keeping these valuations high. So, for example, I've had multiple times in my career where there was a prolonged market correction, which gave me the ability to buy things on a discount.
Well, I bought a few things on discount whenever it crashed when Trump announced his tariffs.
When on Liberation Day.
Yeah.
Yeah, you opened up a brokerage account and did a good
I
job.
did.
But you didn't buy meme stocks and you didn't buy crypto.
I'm not investing in GameStop.
You bought some really solid, what we hope is solid stuff anyway. So I think I think there's a legitimate reason to distrust the system. Where they lose me is when they start talking about the unbanked. I've got a buddy. He's like, "Well, I'm worried about the unbanked in South Africa." I'm like, "When in the world have you ever been concerned with the unbanked anywhere, let alone now related to this?"
This is a little off topic, but I noticed when we were discussing our finance classes, and they displayed a graph of where all the companies, big corporations' money went to, and you see over time it's slowly bigger and bigger to stock buybacks.
Yes.
And the light bulb went off in everybody's head, and you can tell some people got really angry, and some people were like, "Oh, I see, I can make a lot of money off of this."
Off of stock buybacks.
Yeah,
By the companies buying their own stock.
and
back.
artificially inflating the price of the
Correct.
stock.
That's right. Well, and here's why: money was held artificially cheap through low interest rates. So a lot of these large corporations were sitting on mountains of cash, and they decided. It was funny. The greatest example of that right now is Oracle. Oracle, one of the reasons David Ellison is one of the second or third richest person in the world is because he owns a disproportionate amount of Oracle stock, and Oracle went on a stock buyback spree for many, many years, which was great for their stock price, but in order to finance their AI database investments, they had to borrow money. Whereas Google and Meta and what's the other one I'm trying to think? Amazon did not do as much stock buybacks. They had more cash to invest into the AI, all the AI infrastructure, which if you look at the stock price of Oracle, it looked like a tremendous play by David Ellison. Is that the dad's name?
That's
David Ellison. It looked like a tremendous play.
I think it's Larry Ellison.
Thank you.
Larry
son.
Ellison's the dad.
Yeah, Larry Ellison's the son. Tremendous play 6 months ago. Doesn't look so great now. Right?
Yeah. Well,
because they're wondering how they're going to finance all this debt.
Well, I mean, I'm pretty sure they're all getting mad about the whole Warner Brothers situation, but that's another topic.
That's something for your show. All right, so here's the thing. Let's talk about some of the trends in 2026, some of the risky trends. Peyton, you brought this up in show prep. 24-hour trading. What's your understanding of that, and what do you think?
I think it is such a terrible idea.
Well, explain what it means.
Well,
24-hour trading.
The stock market never closes.
The market never closes.
So at 2 a.m, a plane could crash for UPS, and then UPS's stock could crater while the CEO's asleep. And I don't know. I'm not saying feel shame for all these CEOs, but could you imagine having that stress of waking up every morning and having to look on your phone and be like, well, what happened last night? It's
already stressful on publicly traded companies anyway because they suffer a little bit from the whims of the market, and they got to do quarterly reports, which there's an argument being done right now that to move those 6 months, it's not a bad argument. But if you're just constantly under the gun, not only does that put inordinate pressure on the company to constantly be reactive, but it also puts a lot of emotional decisions in people's investing opportunities. Agreed?
Yes, and it leads to overreactions and underreactions to certain things.
Agreed. The other thing that's coming and is really kind of already here, and we don't have time to flesh it all out, we'll talk a little bit more in the next segment, but it's direct investing. So direct investing is just simply, instead of buying a mutual fund or an ETF, there is specifically around AI-driven portfolios where you can create your own portfolio, right?
Yes.
And
you mean direct indexing?
Direct indexing. What did I say?
Direct investing.
Excuse me. Direct indexing. Yeah, build your own S&P 500 basically, right?
Yeah.
The problem, and again, I'm going to call balls and strikes because, we are, at some point, my industry, life has changed and how you adapt to it. I'm not saying that direct indexing is bad. I'm not saying 24-hour trading is bad. It may be a tidal wave coming at us. There's nothing we can do about it. We just want to make sure that we are able to educate our clients on both the pros and the cons of these things. Direct indexing is I've heard somebody say it's like buying a Ferrari to drive to the grocery store. It gives you a really powerful machine to do specific investing, high net worth, complex tax situations, but it actually is a little more expensive than people realize, and there's this built-in argument around tax loss harvesting, which I can tell you as somebody that's going through a tax loss harvesting annual review that we do every year, that is not something you should just be doing if you've never done any. If you haven't passed Accounting 101, you should not be handling your own tax loss harvesting, not to be judgmental. All right, and then the final thing as we're wrapping up segment one here, something's all over the financial news, and it's something that I know a little bit about. I don't know everything about, so I want to be careful and not go too many corners here, but stable coins. Stable coins are what were used, kind of developed as a way for exchanges to tie those to some underlying relatively stable asset, usually something to do with Fed Treasury, and it provided some liquidity to people buying and selling these different coins, different crypto coins. If I traded you straight up 10 coins of one particular crypto for your 10 coins of another crypto, how do you make those two transactions match? That's where stable coins would come out. Well, we've got a recent legislative act called the Genius Act of 2025 that is basically kind of promoting the expansion and the adoption of stable coins. Payne, do you know much about stable coins?
No, this is actually the first I'm hearing of stable coins.
I feel cool. So, and we got an article to talk about it. So stable coins are now with the Genius Act, are legally required to back every coin they issue with 100% liquid assets. For example, I mentioned it earlier, that would be U.S. dollars or short-term treasuries, which are 93 days or less. And they've got new monthly disclosure rules, but there's a couple of problems with them. One is in the Genius Act, And just fundamentally, stable coins cannot pay you interest directly. How you make money is by you do this lending thing to get a certain yield. And there's a lot of issues around that lending. There's a lot of, even with the regulation, investors got to watch out for these certain cracks. There's something called the de-pegging event, and basically that's where the coin drops to a certain level where it's not actually backed one-to-one by cash, by the dollar or treasuries. At that point, it becomes a gambling bet, not a buck. There's the bank run risk, which we saw that, I think it was Tether, where basically they had produced way more stable coins than they actually had cash. That was not a problem as long as everybody didn't try to get all their cash out all at once. They did, and they had the classic bank run, and they were one of the largest failures in the stablecoin industry. And that's always a risk with stable coins that, yes, they're supposed to be back one-to-one, but there are some ways that they can get around that. And then the last thing is just operational friction. Turning in stable coins into real cash at your local bank is going to be pretty clunky, at least for a while, and it's probably going to be very expensive. So they're trying to make stable coins the digital plumbing of the future. I do know that, to be fair, that they can move faster than like a traditional app like Zelle, but folks, do not let the word stable lull you into a false sense of security. If you're chasing double-digit interest rates on a quote-unquote safe coin, a stable coin, you're participating in a high-stakes lending market, whether you realize it or not. For especially you pre-retirees and retirees, and you young friends of Peyton that are gambling all the time, if you want to keep your long-term money in something, quote-unquote safe, and look for FDIC insured accounts. And just view stable coins as what they are. They're transportation. They're not the destination.
I promise my friends are not degenerate gamblers.
Yeah, dude, that's the picture we got painted.
Oh, they don't tell me everything, but I know they haven't lost a ton of money on that. They don't have that much money to lose.
That sounds like that's every gambler's story. So much new stuff, so many temptations. Can be a little overwhelming. You've done a good job of navigating it. Sounds like they're pecking at you. They're trying to be a bad influence.
Well, they're trying to get me so they can get their codes used.
Well, they also want your brain. They want you to be their quant, I think. They're quantitative. Hey,
I guess so.
Yeah. Hey, double major, come figure this bet out for me. Well, listeners, if you want to set up a follow-up conversation with us, the team here at Gulf Coast Financial Advisors, it's very easy. You can call us at 251-327-2124 or visit the website gulfcoastfa.com. So Gulf Coast and then FA is in financialadvisor.com. On the site, there is a blue button in the upper right-hand corner. Click that. That'll put something on my calendar. You can do as simple as a 15-minute introductory phone call. You can set up a 30-minute Zoom. Or our preference, let's do an in-person 1-hour meeting in any of our 3 office locations. We're in downtown Fairhope in the Portico development. We also have an office in Orange Beach. We're just down the road from the wharf. And we have an office in Mobile. It is near the intersection of Dolphin Street and I-65. However you reach out to us, please do it. We'd love to meet with you. All right, folks, coming up next, there's always a lot going on in the world, particularly the world of finance, investments, and money, and gambling, unfortunately. Every week we scour the internet for financial articles relevant to those of you in or near retirement. Then we give you our honest opinion about these headlines. So join us after the break to hear Peyton and I discuss this week's relevant headlines in our Headlines of the Week segment. Stay tuned.
A multidimensional financial services company, Providence Partners serves the needs of independent insurance, financial, and employee benefit professionals. The team at Providence Partners serves other business professionals like property and casualty agencies, registered investment advisors, community banks, and benefit brokers to assist in their clients' risk management planning. Whether an individual or business owner client, this planning includes income replacement protection, planning for extended healthcare costs, family needs, and generational transfers of wealth. At Providence Partners, we give you access to industry specialists. Those specialists focus on business succession, business owner planning, family and household protection, estate planning, planning for that income loss, or planning for long-term care solutions. Providence Partners is an Alabama-based company. We have offices in Birmingham and along the Gulf Coast. Our website is providencepartners.org, and you can reach us any of the working days.
Welcome back, Coasting in Retirement. Your host, Josh Null, here alongside guest co-host, my oldest son, Peyton Null. So as we discussed before the break, every week we scour the internet for financial articles that pertain to those of you in or near retirement. Our job, or at least we tell ourselves it is to help you all understand how these headlines impact you, especially when it comes to your money. Now, quick note, if you want to read our reference articles yourself, We include the links in our show transcript, which you can find on the website, gulfcoastfa.com. Just go to the podcast tab, find the episode that you want to re-listen to, find the transcript, look for the article links there. And all that said, without further ado, here's Peyton with the headlines of the week.
All right, let's get started with the New York Post. The Post, and just about every other major financial outlet this week, is reporting that JP Morgan Chase just officially launched its first ever tokenized money market fund. It's called the My On-Chain Net Yield Fund, or MONY for short.
It's a great name, actually.
MONY.
I wish I thought of that.
JP Morgan Chase is seeding this with $100 million of their own money and running it on what it's called the Ethereum blockchain. They're saying it's the future of finance because it allows 24/7 trading and near instant settlement. But here's the kicker for our listeners. To even get in the door, you need to be a qualified investor. We're talking $1 million minimum investment. And for individuals, you usually need at least $5 million in total investments just to play. My question, given that money market funds are generally considered cash equivalent, if the biggest bank in the country is moving their safe money market funds onto the blockchain, does that mean our retirees should finally stop calling crypto witchcraft and start looking for a digital wallet? Or is this another case of Wall Street building a shiny new toy for the ultra wealthy that doesn't really change anything for investors?
It's more the second thing, which is funny because the head of JP Morgan Chase is, what's his name, Peyton? It's, good grief. We'll come back to it. But the head of JP Morgan Chase has been Jamie Dimon, excuse me. He's been pretty public in the past about his distrust of crypto. I mean, he called it a scam and called it all things. So this was a really about face. And so you always, when you're trying to decide why a company or a person is doing something, you always want to look at what is the motivation. Well, the motivation here, I think, is they just had a little bit of fear of missing out, right?
Oh,
Or what I call my FOLO.
Yeah, your fear of looking old.
Fear of looking old. Yeah, they didn't want to be the last bank standing that wasn't trying to do this tokenized thing. So couple of housekeeping, if you will. Money market funds are generally, Peyton mentioned it, they're generally considered a cash equivalent. They're not cash. They're not as liquid as cash. Usually you have a T+1. You have a 24-hour settlement period to generate cash. They trade at about $1. It is a monumental screw-up when a money market fund drops below that dollar value. That means something has gone really, really haywire. And it's only happened a few times in history, but it is in investing history. But it is, anything. Even a money market fund will have at least some type of baked-in element of risk. And Peyton mentioned that they had a $1 million minimum investment to go onto this blockchain-based money market fund called MONY, M-O-N-Y. That's not that unusual. Schwab's got, I can't remember off the top of my head, SWAXX, I could be wrong. But Charles Schwab has some money market funds that require at least a minimum of $1 million. In exchange, you get a little higher interest rate than the other money market funds that don't have a minimum investment, right? So that part all tracks. What is really kind of the basis of this is, we mentioned in the first segment, is the Genius Act that was passed earlier this year, more or less giving banks the green light and at least some regulatory clarity to issue a blockchain-based money market fund like this. But folks need to understand a couple things. This is making, I can't say that word, Peyton, tokenization?
Tokenization.
Yeah, thank you. I struggle with three-syllable words. All it is taking an already existing product and just putting it on the blockchain, which, again, not to offend all you crypto bros out there, but the blockchain is really just an incredibly, incredibly fancy and sophisticated database is what it is, right? Mm-hmm. This is not investing into traditional crypto, if you will, like a Bitcoin. This is not buying Bitcoin. This is buying what, by most people's definition, is a fairly boring investment, a money market fund, which is usually based on some very short-term debt, and then you're just putting it on what's called a digital ledger. The thing that Peyton mentioned was this has 24/7 settlements, 24 hours a day, 7 days a week, because it's on the blockchain. The problem is the tokens might move 24/7, but the underlying assets, which are going to be U.S. Treasuries, do not. So you can't sell $1 billion worth of Treasury bonds at 2 a.m. on Sunday, right? So I don't know how they're going to make that match up. I'm sure they've got an answer for that. But the bank may not. If there's a run on this fund, which this thing is just one big giant experiment to see if they can make money off this space, but if there's a run on this fund, like a market panic during the weekend, the bank, in this case JP Morgan Chase, may not be able to liquidate the actual bonds that are being held in the money market fund fast enough to cover the blockchain redemptions, which causes what's called a liquidity mismatch. And this liquidity mismatch we talked about earlier, first segment with Tether, That is what's led to every major crypto collapse in crypto's very short history. Okay.
Well, looking at a graph of crypto looking at it on a graph is insane. It's just up and down, up and down, up and down.
It's nuts. And my thing, not to get on a segment or a tangent, but who actually determines the price of these things has always been a little dubious about this. Not that there is some element of gamemanship and salesmanship, and maybe even at times in its history fraud with the various exchanges, but at least for the majority of the positions being traded on the major exchanges, there are thousands, sometimes millions of buyers on one side of the equation and thousands, sometimes millions of sellers on the other side. So you get at least some kind of market consensus. Here, you're talking about that you have somebody who is the market maker. Who's going to be now with stable coins? It's going to be more liquidity issue. But when you're talking about the price of Bitcoin, or definitely when you're talking about the price of meme coins or all these other coins issued, you have to ask yourself, who is actually the market maker? Who's the one setting the price? And does that person have a third disinterested, arm's length third party interest in the price of that coin? What crypto has proved time and time again is that is just not true. The people making the market have too much of a vested interest in the actual performance of the underlying coin. Make sense?
Yep.
The other thing that's kind of funny is crypto is designed to be decentralized. Means there's no middleman, right? There's no bank. It's the ability to all the world's poor that all these 25-year-old guys are now suddenly worried about. It's a way to give them access to a bank, and they're not totally wrong. I mean, there are some good stories about how it's helped people in oppressive societies actually get some money going. I'm calling balls and strikes. But it's funny that J.P. Morgan is entering the space because they are the world's largest middleman.
Yeah.
So they're kind of like, okay, well, we'll try this thing. We're coming into your party, Peyton. We were 20 years graduated, but we're coming to your party, and we want to be just as cool as everybody else at your party.
You're saying this like it's happened before, and it has happened.
Yeah. Well, you talking about when I come to your parties?
Yep.
Oh, come on now. I fit in just fine, right? So that's mean. Now, plus I'm paying for your space. So I'll come anytime I want. Whoa! So really, at the end of the day, this is for y'all that are interested in this. You're just understand you're going to be a guinea pig with this. It's a J.P. Morgan's using their wealthiest clients as beta testers for this new software. If there's a smart contract hack, if there's a bug in the code, these sophisticated, accredited, wealthy investors are the ones that will take the hit first while the bank works out the kinks, and then maybe potentially, if it works out, brings it down to people that don't have that kind of net worth. Yeah, this is definitely FOMO and FOLO on J.P. Morgan's case. So very good. That stung. What are you talking about? I'm the old guy coming to the party.
That stung?
Yeah.
Are you ready for the next
You
article?
just better never say that to Michelle. Michelle fully fits in.
Yeah, Michelle does fully fit in.
Okay, there you go. All right.
Yeah. You sit off in the corner. She is life of party.
I'm tired, man.
All right, Dad. We just talked about the big banks moving their cash onto the blockchain. But our next headline serves as a serious reality check for anyone thinking that the wild west of crypto has finally been tamed. The Bank Policy Institute, which represents the nation's largest traditional banks, just released a report titled Stablecoin Risks, Some Warning Bells. In the first segment, we talked about the Genius Act and how it was supposed to bring bank-like safety to these digital dollars. But BPI is sounding the alarm, and these so-called stable coins are still prone to massive depegging events like the cratering we saw this past October, and that retail investors are often the very last ones in line to get their cash back when the exit doors lock. When the word stable is in the name, but the underlying plumbing is still full of risky leverage and these looper speculators, is this a tool our listeners can actually trust for their retirement, or is it just another putting lipstick on a pig situation?
Yeah, you can't trust it just yet. Now, for clarity, we were talking about the J.P. Morgan Chase. They're issuing a money market fund that is going to be on a blockchain ledger. Okay, it is not a stable coin. I don't want to get too much in the political bent of this, but an issue of a stable coin is Trump's is issuing their organization is issuing a stable coin.
Of course they are.
Right. So fair enough. I mean, and they're not the only ones, but the problem, we talked about this a little earlier, but the problem with the stable coins, one, the name, I have heartburn with the name. It implies more inherent stableness than there actually is. But the other is, the big thing is the depegging problem. Stable coins right now, the pitches are fixed at $1, and they're safer now because of the Genius Act. And maybe they are a little bit. I mean, this is, again, to be fair, this is still a fairly immature, growing, young industry. I just don't know if it's ever going to get out of its own way and become something that any of us that are fiduciary-based financial advisors could ever even remotely recommend to any of our clients. I doubt it, but we'll see. The warning sign. So this BPI article, bank was again Peyton, the bank.
See, the Bank Policy Institute.
All right, yeah, that sounds pretty official. They point out that retail investors can't actually redeem coins with the big issuers, which one was Tether. Only big institutional market makers can, right? Again, who's determining the price? The risk is if those big players get scared or they get capital constrained, which is a funny, it's a fancy way of saying they run out of cash, the price on the exchanges crashes. There was one, the USDC dropped to 87 cents during a recent collapse. And we even had one, an algorithmic coin, USDE, which I'm not familiar with. It cratered to 65 cents. Again, these are things that are supposed to be $1. They're supposed to be stable, right? The other thing is the leverage trap, and this is called the looper trap, which I'm not familiar with that term, but the pitch is that you can earn 4 to 6% interest by lending your stable coins on various platforms. Okay, fine. But where is that interest coming from? It's coming from the loopers,
Which is such a crypto name.
It is a crypto name, isn't it? Those are loopers are I learned that I was today years old when I learned what a looper was. Those are speculators who borrow your quote unquote safe stable coins to place massive multiple leverage bets on riskier crypto assets. Does that sound like something that is a good long-term strategy?
No, it sounds like a terrible long-term strategy.
As long as number go up, which is the name of a great crypto book I recommend people to read, then everything works out. But when number go down, all HE double hockey sticks breaks out. So the danger is a liquidation downward spiral. For example, just recently, October 10, 2025, there was a record $20 billion liquidated in a single day on this event because there was a downward spiral of liquidity. So when you lend, quote unquote safe JP Morgan tokens to earn a little extra yield, you are basically funding a gambler's habit. And remember, we're trying to keep the younger generation from being gamblers.
Well, I do think it's funny that the looper trap, before I've heard the word looper, is that movie with Hayden Christensen, the Anakin Skywalker, and it ends with him closing the loop because it ends badly for everybody.
So maybe that's where the name came from.
Maybe.
Yes, or maybe they predicted the future too. Maybe they actually went into the future. Mind's melting here. And then last thing is what's called the locked door problem, no maturity. You can only get your money back if there's a surplus of new money putting money in. Does that ring a bell for anybody? That's a classic definition of a Ponzi scheme.
Yeah.
Yeah. If everyone tries to leave at once, their exit doors are locked indefinitely. So here's the bottom line, everybody. The Bank Policies Institute report should be required reading for any of you all out there that are thinking about these new tokenized funds. They're warning that the Genius Act creates a loophole. It makes these coins look like regulated money, but it doesn't stop the crazy leverage happening behind the scenes. JP Morgan and the other ones are dressing us up in a suit and tie, but it's still, like Peyton said earlier, it's still kind of the wild, wild west, at least for now. We'll see what happens. But even if they started hard coding prices of certain assets to keep the liquidations from getting triggered, which means basically that means BPI is saying that the bank shifts the risk directly to you. The bottom line is if you're wanting, if those y'all that are looking for like a relatively guaranteed safe 5%, which we can argue on maybe that's not truly
Treasury
safe.
bills.
Look at Treasury bill. You got multi-year guaranteed annuities. You got bank CDs. You got all. Just don't do this looper game.
Treasury
with your
bills are the risk-free in our finance calculations are always the risk-free investment.
We're running short on time. We got time for one more.
All right, final article today from one of your favorites, Michael Kitces. The blog is titled The Future of Financial Advice. This article argues that we are entering an era where artificial intelligence and new engagement tools are going to handle the heavy lifting of financial planning, everything from data gathering to building the actual models. The premise is that the technology will become a commodity and the real value of an investor will move away from picking stocks and toward the human experience and specialized niches. As I was reading through this vision of tech-enabled future, it sounded a lot like a double-edged sword. Is this technology actually going to give retirees better, more personal care, or is it reshaping the service model, just a fancy way for the industry to automate the human right out of the room while still charging a premium fee? Are we moving towards better advice or just a more expensive version of a chatbot?
So it's funny. Back when Betterment and Wealth, I can't remember, but back when robo-advisors came on the scene, hot and heavy, 2013, 14-ish, they were supposed to put human flesh and blood financial advisors out of business quickly, right? That hasn't happened. In fact, they have moved their model closer and closer to the human element in some of their restructuring. And we've talked on this episode about I'm sitting here as a fee-based financial advisor. I don't want to find the day where I'm like the broker guys and gals, where they're a dinosaur. I don't want to find the day where I'm a dinosaur. The article's right. The math of financial planning has become a commodity, right? If you're sitting with somebody and they are very braggadocious or very focused on the return, there's nothing wrong. You want somebody that actually knows how to get a return out of the market. That's true. But if that's their own selling point, that is a commodity, and it's a very fragile thing, and especially nothing you can guarantee. Where the real value, in my opinion, comes in is the financial planning, specifically around behavioral coaching. And Michelle and I talked about this on the last episode. She said I needed a behavioral coach. She's probably not wrong, but behavioral coaching is, think of it this way. Most people know how to go to Planet Fitness and pick up some weights and get on a bike and do all this stuff. How much better do you do if you got somebody that's really experienced and help alongside of you, helping you with your fitness program and your eating program and holding you accountable and encouraging you, right?
Right.
That's behavioral coaching. Transplant that over to financial world. That's our primary value play is what we do, comprehensive financial planning. And as this article says, high-tech engagement, that's a great way of being digitally ghosted at some point. Do you agree with that?
I definitely agree.
Yeah. We have a certain rule. Within reason, we're always going to get back to somebody within 48 hours. This type of engagement, I would be very dubious on. Maybe it is responsive, but do you really get specialized, individualized attention? And at the end of the day, our job is to be a guide. As Peyton knows, I have a ton of life experience, both good and bad, and I can lean on that experience to help guide my clients in business matters and sometimes personal matters. Even the smartest AI right now, and maybe this will change, but even that is not going to have that baked-in human life experience to give you that advice. All right, very good. Well, listeners, if you want to set up a follow-up conversation with us at Gulf Coast Financial Advisors, start with giving us a call, 251-327-2124, or find us on the website, gulfcoastfa.com, blue button, upper right-hand corner, click it, put something on my calendar. And again, we have 3 office locations, downtown Fairhope. We're in Orange Beach. We're also in Mobile, off near Dolphin Street and I-65. Reach out to us. We would love to meet with you. All right, folks, coming up next, Josh's Crystal Ball and Big Mouth. What have been some of my predictions? What we're going to do, Peyton and I are going to do, we're just going to do some fun predictions.
Yes, I have some fun ones.
We're very short on time, so let's get to it. Coming up, stay tuned. Whether it's building a business from scratch with your own 2 hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's GULF, like the Gulf of Mexico, Coast, FA as in financialadvisor.com. Welcome back. Your host, Josh Knoll, here, joined by guest co-host Peyton Knoll. So, Peyton, we're going to get right to it. This is our Crystal Ball and Big Mouth segment. You said you had, here we are, wrapping up 2025. You said you have 2 or 3 really fun predictions to make, and we'll revisit these later in 2026 and see how close you are. So let's see what Peyton's Crystal Ball and Big Mouth have to say for 2026.
All right, my first prediction has to do with OpenAI and Disney's recent $1 billion deal that they give access to their characters, not the likenesses of the actors themselves, but just the characters. And they were just the first studio to fall in line to do this, and I think this could blow up in their face.
Okay, how so?
Well, Sora, everyone downloaded it immediately when it came out, and then everyone stopped using it. So I think they're hoping that this gets another big bubble of Sora, and they said they're going to put some of these videos on Disney Plus itself. And I think it devalues their own content if you just have these AI characters running around.
So for those of you who are not familiar with that, the deal he's talking about is OpenAI, which is the kind of the OG AI company, if you will, is Disney is letting them use characters where people like me and Peyton can go in there and we could take Darth Vader and have him fighting Mickey Mouse.
Yep, basically
and generate this AI generated content, right?
Yep. And I think it's going to blow up in their face.
Well, I think it definitely devalues it. It could be fun for a while, but that seems very short-lived.
Like
you
get the law of
bored.
diminishing returns.
Law there.
Yeah.
Well said. All
Yes.
right. What's your other prediction?
My other prediction is I think Netflix does, in fact, end up with Warner Bros. I think Paramount is they're trying to do their hostile takeover of the company, and I don't think it's going too well, and it's blowing up in their face. And I think Netflix is going to take it.
So this is very inside baseball of you. But for those of you all that don't pay a lot of attention to the media, if you will, or Hollywood, if you will, the Warner Brothers studio, which has all the Batman, DC, Superman, it's got a ton of stuff.
Yeah.
They are right now in a little bit of a bidding war where Netflix is trying to buy them, but also Paramount. We mentioned his name earlier. Larry Ellison's son, David Ellison, has recently bought Paramount, is now trying to buy Warner Brothers. There's a lot of moving parts to it. There's a lot of scuttlebutt going on.
Even with the presidency.
Even the president's weighing in. Warner Brothers is not just Warner Brothers; also includes CNN and some cable networks, and there's just a whole mess there. But if you ask me on any day who's going to get it, I would say, man, I don't know. But you're predicting Netflix is going to be the winner.
Well, Netflix doesn't want CNN or the cable stuff, so the Paramount does, and they're giving them $1 for that when Warner Brothers thinks it's worth $3 or $4.
And so what that means is, for you all that are even remotely interested in antitrust, that means the world's number one streamer would buy the world's number three or number three streamer, which is HBO Max, which is Warner Brothers.
Yeah, so they're going to use Google as their argument that they're competing against Google, which I don't know how well that holds up, but we'll see what happens. I think Trump will go whichever way he personally wants.
All right. So let's do one final prediction for something that everybody's going to recognize. Your esteemed university, Auburn. What's going to happen with their new coach, Alex Golesh?
Alex Golesh.
He's Russian.
I think we're going to go to a bowl game next year.
All right.
Now, I don't think
That's a pretty low bar.
That's a low bar. But we couldn't do it this year. We couldn't beat Kentucky this year. I still don't have a total amount of faith to turn it around. I was right there at the sidelines when Cam Coleman fumbled that ball at the Iron Bowl, and that just sucked all the air out of the room. But I think we can do better than that, and I think we're going to get at least. I think I'm shooting for solid 8 or 9 wins is what I predicted today.
I hope you're right, because
I don't think we're going to beat Bama. But
you're in your second year there. You deserve to have. Auburn needs to return to its esteem as one of the top 10 programs in the United States.
Yeah, Vanderbilt. I almost went to Vanderbilt. They're doing better than we are.
Well, I mean, Indiana is number one, so the world's totally turned upside down in college football, right?
Yes.
Yes. All right. Well, folks, that is our show for this week. Real quick, if you want to reach out to us, the number is 251-327-2124. The website is Gulf Coast FA, FA's and Financial Advisor.com. Reach out to us. I want to give a huge thank you to my guest co-host and the producer of the show, Peyton Null. Good job, son.
Thank you
Was
for
it
having
fun?
me. So much fun.
There you go. Thank you to our show sponsor, and you're going to take back what you said about me at your parties.
Oh.
Thank you to our show sponsor, that's Providence Partners and Mr. Jay Stubbs. Thank you to our awesome radio station, that is FM Talk 106.5 out of Mobile. Many thanks to the provider of our show music, that is local band Sloth Racer, Mr. Franklin Pratt. And as always, my sincere appreciation for all of you out there that have been listening and joining us on this journey. We'd love to be a part of your journey as well. Till we talk again, have a wonderful and productive week. This has been Coasting Retirement with Josh Null. Gulf Coast Financial Advisors, LLC, known as GCFA, is a registered investment advisor offering advisory services in the state of Alabama and in such other jurisdictions where it is registered, filed the required notices, or is otherwise excluded or exempted from such registration and or notice filing requirements. Registration does not indicate or imply that GCFA has attained a particular level of skill or ability, nor does it constitute an endorsement of the firm by the Securities and Exchange Commission, the SEC, or any other state securities regulator. The Coasting and Retirement radio program serves mainly to disseminate general information, including those pertaining to GCFA's advisory services, together with access to additional investment-related information, publications, materials, and links. The publication of this radio show should not be construed by any client and or prospective client as GCFA's solicitation to effect or attempt to effect transactions in securities, nor should be interpreted as GCFA providing personalized investment advice or any type of professional advice for compensation wherever this program is broadcast. Any subsequent direct communication by GCFA with a prospective client will be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. Certain information, news stories, headlines, data, charts, graphs, figures, or statistics presented on this radio program may have been obtained from third-party sources that are believed to be generally reliable or which GCFA may not have independently verified. GCFA does not and cannot guarantee the timeliness, accuracy, or reliability of any such third-party information and undertakes no obligation to update or correct any information that may become obsolete
obsolete, unreliable, or inaccurate. This radio program also contains the opinions, views, and perspectives expressed by Josh Knoll and any other GCFA representative, which are solely their own and do not necessarily reflect the opinions, views, or perspectives of GCFA as a firm. Such personal views and opinions should not be construed as endorsements or professional advice from GCFA. GCFA makes no representation or warranty regarding the accuracy, completeness, or reliability of any information on this radio program and disclaims any liability for any direct or indirect loss or damage incurred from using or relying on such information. GCFA and Providence Partners are not affiliated, nor are any of their respective representatives.